Every time you tap buy on Trade Republic, Scalable Capital, or Trading 212 and pay zero commission, someone is still paying. And on June 30th, 2026, the EU is pulling the plug on that entire system. The ban on payment for order flow is final. No extensions, no exceptions. Millions of European investors are about to see their trading costs change, and most of them have no idea it's coming. Here's exactly what's happening, which brokers are hit hardest, and what you should do before the deadline.
Here's how it actually works. You place an order to buy 10 shares of VWCE through your broker. Instead of sending that order to a public exchange like Xetra, your broker routes it to a market maker, a firm like Citadel Securities or Virtue Financial. The market maker fills your order and pays your broker a small fee, maybe 50 cents, maybe €2. That payment is why your trade shows zero commission. But here's the catch. The market maker profits from the spread, the tiny gap between the buy and sell price, and that spread is often slightly wider than what you'd get on a transparent exchange. So you are paying, you just can't see it on your receipt. The European Commission decided that this hidden cost and conflict of interest needed to end.
Let's put real numbers on this. The Dutch financial regulator, AFM, studied PFOF execution quality and found that investors received roughly €4 worse execution on every €5,000 traded. That's about 0.08% per trade. ESMA's broader analysis across Europe estimated the hidden cost at 0.04 to 0.20% per transaction, depending on the instrument and order size. For someone investing €200 a month into an ETF savings plan, we're talking about 8 to 40 cents per trade, barely noticeable. But for an active trader turning over €50,000 a year, that adds up to 20 to 100 euros in invisible losses every single year. The uncomfortable truth, free was never actually free. The question is whether what replaces it will cost you more or less. The regulation is called the revised MiFIR, officially Regulation EU 2024/791. It was finalised in March 2024 as part of the EU's capital markets reform package. The hard deadline is June 30th, 2026. After that date, no broker operating in the EU can accept payments from market makers for routing retail order flow, period. The EU gave a 2-year transition period, specifically because Germany was the largest PFOF market in Europe, generating an estimated 200 to 300 million euros in PFOF revenue annually. BaFin, Germany's financial regulator, has been monitoring neo-brokers closely throughout this transition, but the grace period is over. June 30th is final.
Not all brokers are equal here. Let's break it down. Trade Republic, heavily impacted. PFOF accounted for an estimated 50 to 70% of their trading revenue. They've been preparing aggressively. Full banking license from the ECB, interest on cash deposits, a Visa debit card. They're pivoting from a trading app to a financial super app, but the core free trade model is under pressure. Scalable Capital, heavily impacted. Their free-tier brokerage depended on PFOF through GetTex. Their controversial response, building their own exchange. More on that in a moment. XTB, moderately affected. Their real money comes from CFD trading, which makes up 70 to 80% of revenue. Stock and ETF trading may see small fee adjustments, but XTB will survive this easily. Trading 212, moderately affected. They already earn significant revenue from FX conversion fees and CFDs. Expect minor adjustments, not a fundamental change. DeGiro, barely affected. They already charge small commissions per trade and don't rely on PFOF as a primary revenue source. Business as usual. Interactive brokers, not affected. They use a best execution model with explicit commissions in Europe. This validates the model they've been running all along. Revolut, minimally affected. Trading is a tiny part of their business. They already charge commissions on most tiers.
This is the most interesting part of the story.
Scalable Capital isn't just accepting the ban, they're trying to build around it. Their plan, the European Investor Exchange, or EIX, a regulated exchange specifically designed for retail order flow, operated in partnership with Börse Stuttgart. Here's how it works. Instead of a market maker paying the broker directly, which is now banned, the market maker pays a fee to access the exchange. And who profits from those exchange fees? The entity affiliated with the broker. Critics call this PFOF in a different wrapper. The conflict of interest is the same. The broker still has an incentive to route your orders where it makes the most money, not where you get the best price. Arguably, it's even worse. Vertical integration means the broker now controls both sides of the transaction. ESMA has signaled it will scrutinize structures designed to circumvent the ban's intent. BaFin is watching. Whether EIX survives regulatory review is an open question, and a test of whether this ban has real teeth or is just theatre.
So, is the era of zero-commission trading in Europe over? Not entirely, but it's changing shape. Here's what brokers are moving toward. Small per-trade commissions. Expect 50 cents to €1 per trade at brokers that currently charge nothing. Subscription models. Scalable already offers this. Free plan with limited features, or pay €3 to €5 per month for better conditions. Interest margin on cash. Trade Republic earns the ECB deposit rate on your uninvested cash and shares some of it with you while keeping the spread. FX conversion fees. Trading 212 charges 0.15 to 0.50% on non-base currency trades. This becomes more important when commissions disappear. Securities lending. Brokers lend out your shares to short sellers and keep a share of the income. Here's the paradox. Spreads on public exchanges should actually tighten after the ban because more order flow will hit transparent venues where market makers genuinely compete. You might pay a visible €1 commission but save €2 on better execution. Net result, some investors end up better off.
5 concrete steps. 1. Don't panic. This is not a crisis. Brokers have had over 2 years to prepare. The transition will be orderly. 2. Watch your broker's announcements. In the next 3 months, every affected broker will publish their new pricing structure. Read the fine print. 3. Calculate total cost, not just commission. The real comparison is commission plus spread plus FX fee plus custody fee. A broker charging €1 per trade with tight spreads can be cheaper than a free broker with wide spreads and a 0.50% FX markup. 4. If you're a savings plan investor doing monthly ETF purchases, relax. Most brokers will keep automated savings plans free or very cheap. It's their best tool for acquiring long-term customers. 5. Don't switch brokers preemptively. Wait until the new pricing is public, compare properly, then decide. Moving now means paying transfer fees for a situation that may not require it.
That's the full picture on the EU PFOF ban. If you found this useful, subscribe. I cover European investing without the hype every week. Drop a comment. Which broker do you use, and are you planning to switch after June? I'm genuinely curious what the community is thinking. And if you want to see a full broker comparison for post-PFOF Europe, that video is coming soon. Not financial advice, always do your own research.